Good afternoon. Here is the one thing worth understanding today. For 3 years, the market has kept score on artificial intelligence by watching how much the largest technology companies spend. That number is still going up, but underneath it, something changed that very few people put on a chart. These companies have largely stopped paying for the build-out out of their own cash and started borrowing for it. In the space of about 18 months, the share of that spending funded by new debt went from roughly 9% to roughly 32%. That is not a small accounting detail. It quietly converts the biggest equity story of the decade into a credit story, and credit stories follow different rules. The board, the S&P 500, closed Friday at 7,785 and spent Monday morning going almost nowhere. Underneath the index, the tape disagreed with itself. The Dow was down about 1/3%, while the Nasdaq was up about 2/10, which tells you money kept crowding into the same handful of technology names. In rates, the 10-year sits near 4.7%, but the number that matters is at the long end. Last week, the Treasury sold $25 billion of 30-year bonds and paid 5.216%, the highest yield at that maturity since 2001. Gold is near $4,437 an ounce, firmer as the dollar eased. Bitcoin is near $62,900 with no real bid. And Brent crude is near $88.85, which, given what expired today, is the most interesting number on this board. Now the segment this publication is built on, 3 places where the consensus and the evidence have come apart. The first, everyone believes that record artificial intelligence spending is a show of financial strength because the companies doing it are the greatest cash machines ever assembled. The tell says the financing mix flipped. Incremental debt went from about 9% of that capital spending in the 2024 fiscal year to about 32% by the middle of this year. In July, Alphabet reported its first quarter of negative cash flow, and its long-term debt more than doubled in 6 months to roughly $98 billion. The spending is real. The self-funding is not. The second, everyone believes the ceasefire between the United States and Iran was extended this morning because that headline was everywhere. The tell says be careful. The Islamabad memorandum was signed on the 17th of June, ran 60 days, and could be extended by mutual consent. That window ran out today. Pakistani government sources say both sides consented and that they are still exchanging messages over how long an extension would run. But neither Washington nor Tehran has publicly confirmed it, and Iran has since rejected the account entirely, saying no negotiations over an extension took place. So the market is pricing peace off an unconfirmed third-party report that one of the 2 parties has now denied. Brent moved less than 1%. Third, everyone believes Michael Saylor's conviction in Bitcoin is absolute, and this week he said publicly that Bitcoin is the only game in the casino where we can all win. The tell is in his company's own filings. Between the 3rd and the 9th of August, Strategy sold 1,690 Bitcoin at an average of $64,262. Its average purchase price is around $75,385. It sold below cost. It also sold 6.5 million of its own shares, raising $653 million, and used the proceeds to lift its dollar reserve to $4.65 billion. Holdings are flat at 840,000 coins. The message says conviction. The Treasury says build cash. Follow the money and start where the pressure actually is. The front end of the rates market is calm. The consensus has largely written September off as a meeting where the Federal Reserve does nothing, on softer consumption and a friendlier inflation path. The long end is not calm at all. That 30-year auction did not just clear at a high yield, it cleared with weak demand. The bid-to-cover ratio was 2.39, and the primary dealers, the firms obligated to show up whether they want the paper or not, had to absorb 11.5% of it. Both are worse than their averages over the past year. Deficits are the largest driver, and debt service now runs ahead of national defense spending. But there is a second bidder for long-dated money that did not exist at this scale 2 years ago, and that is the data center build-out. When governments and corporations both need to borrow long at the same time, long money gets more expensive for everybody. The dollar easing and gold firming near $4,437 is the same conversation from the other side. Crypto shows the cleanest divergence on the board. Price is heavy. Bitcoin near 62,900, roughly half of where it peaked last October, with Ether soft alongside it. And yet the institutional plumbing keeps getting built. Regulatory guidance has loosened. Tokenization of ordinary money market funds is happening at real scale, and the largest asset managers are now doing in months what used to take them years. That gap between a weak price and a strengthening pipe is the thing to watch, because historically one of the two is wrong. Note also that the most visible corporate holder of Bitcoin spent this month raising dollars rather than adding coins. A word on positioning, drawn from market and social sentiment monitoring rather than from prices. The mood is unusually split. Commentary is heavily negative on the economy at the household level, and survey data backs that up, with roughly 3/4 of Americans rating the economy poorly. At the same time, professional positioning has been leaning in, with hedge funds reported to have bought equities every day of last week at close to the fastest pace of the year. So you have a public that is angry, an institution that is buying, and an index that is flat. That combination is not stable. It usually resolves through a catalyst rather than through drift. So here is the tell, the single most revealing data point today: 9% to 32% in about 18 months. That is the share of the artificial intelligence build-out funded with borrowed money rather than cash from the business. And last week, Nvidia put a frame around it, announcing partnerships with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to mobilize more than $500 billion of third-party capital, structured specifically so that it does not land on Nvidia's own balance sheet. That is a serious piece of financial engineering, and it deserves a serious look rather than a slogan, which is exactly what today's Focus episode does. Watch that one next. Sectors in play, 3 today. Housing and the consumer remain the soft spot. Builder sentiment is still deep in contractionary territory, and the retail read this week will come from Walmart and Home Depot rather than from any survey. Energy is the quiet one. Crude barely moved on a day when a ceasefire deadline expired, which is either genuine confidence or a market that has stopped pricing that risk at all. And launch and space hardware had a genuine milestone over the weekend, with 2 rockets flying 38 minutes apart from opposite coasts of the United States, beating a record of 65 minutes. The interesting part there is not the spectacle. It is that turnaround time has become a manufacturing statistic rather than an aerospace one. On the radar this week, Walmart and Home Depot report, and together they are the cleanest read available on whether the angry consumer is actually spending less. The minutes from the last Federal Reserve meeting land, and purchasing manager surveys follow. And the duration of any Iran extension, if one is genuinely agreed, should become clearer. Then the scorecard, because this publication writes down its calls and grades them. Today adds one. The call is that the debt-funded share of the artificial intelligence build-out keeps rising from roughly 32% through the middle of 2027. If that share flattens or falls, the call is wrong and the self-funding argument was right all along. That is dated, specific, and can be checked against us. The close, if you take one idea from today, take this one. For 3 years, the right question about artificial intelligence was whether the technology would work. That question is largely settled. The new question is who is holding the paper and on what terms, because the build-out has quietly moved from the income statement to the balance sheet, which means the number that tells you how this ends is probably not the next model release. It is the next long-dated bond auction. That is the brief. This is the asymmetric signal, one contrarian read a day. Subscribe, research and education only, and nothing here is financial advice.